I can't see you right now. I'm connecting our server.
I'll let Amelia answer that when she joins.
It better be pink.
I believe
it's pink. Oh, it's pink.
The hat game is it's incredible in this room.
You just start turning it into a contest.
It's hot pink. In fact, I showed it to my boss's boss, and he's like, "That's really pink." Like, yep. That's how we roll. We're going to be diverse and inclusive. We're going to have hot pink.
That's my favorite color. Okay. And I think we're live. We were trying to be fancy for you guys this week, but see where fancy got us. All right. Happy Thursday. We apologize for the delay in getting started today. We're using a new platform that was going to have the questions at the bottom of the screen, and it was going to be very fancy. But the fanciest thing we're going to get this week is Patrick's new data hat. So at least we have something to bring to you guys.
It's a thing. It's a thing.
To apologize for the late start. Happy Thursday. Welcome to the 5th event in our virtual Thursday series. I'm Amelia Martin, the founder of Data Science Connect. We're the largest data science community in the Southeastern United States. However, today, we're all excited to share this with an audience joining us from all over the world, including two of today's speakers, one joining us from Hong Kong, Carolina starting in the morning with us at 5 a.m. to be exact, and another joining us from Israel, where he's tuning in a little past midnight. Before we get started, we're going to take a couple moments to thank the people and the organizations who really make what we do possible. Our presenting sponsor, Amazon Web Services, also known as AWS, as well as our signature sponsor and long-term friends at QuantHub. And lastly, thank you to our supporting university partner at the University of Virginia School of Data Science, which is also the first school of data science. Thank you to all of you for your continuous support. It's a huge honor to work with you. Now we're going to hear from our pink data hat wearing Patrick Mchugh.
And a gray data shirt. Look at that.
Oh,
I'm all
goodness.
decked out. I got a hat. I got a shirt. You got to have game. So thank you, Amelia, and the Data Science Connect community, and everyone for joining us. I'm Patrick Mchugh with Amazon Web Services, and we're proud to be sponsoring this event. I think we're up to our 5th, which is very exciting. Finance is rapidly evolving at both personal and business levels. Think about how our methods of payment have evolved from cash to the mobile app, or how a mortgage application has gone from sitting at a bank to sitting on your couch. Then layer in the balancing act of social justice and fair lending that should be blind to race, gender, marital status, and criminal history, but balancing with the need for financial institutions to manage their risk, remain solvent. So how can data science help with these challenges? I recently read a great article titled "Intuit's Machine Learning Helps You Save Money with the Use of AML." So there's lots of very intriguing use cases. In reading this article, one of the things that made me laugh was how Intuit and AML is explicitly helping shoebox people. And if anyone has ever been in the accounting business, they know what a shoebox person is. They're that small business that keeps all the receipts in a shoebox. That's why it's called that. So AML is definitely helping that and helping us all save money in many ways. So we look forward to this panel and how they're seeing AML in the evolving fintech space. Thank you.
And next up, we have, I mentioned it to the audience from last week, but if you want to reach out to Matt Cowell, CEO of QuantHub, and ask him about his booth last year at our data science in Atlanta this past fall data science conference, that would be a good conversation starter. He'll provide his contact information in his show. Matt Cowell, CEO of QuantHub.
Thanks again, Amelia, for bringing that up. It turns out when you have conferences at museum type places, there may or may not be some interesting art behind your booth. I'll just leave it at that. May or may not have clothes on the things that are in the painting, so kind of a little odd. Anyway, Amelia, thanks for having us. We're super excited to be here and to be sponsoring this event again. We were here last week in the event and enjoyed the conversation that week, and certainly look forward to this week. With FinTech, it's an area that we're excited to sponsor, because at QuantHub, what we do is we have an assessment and upskilling platform for all things data. And so we exist to help organizations build great data teams and great data talent. And so our assessments help organizations that are actually hiring. So we work with some of the largest companies in the world, and we're a relatively early stage company, but we've grown quickly and have people using our hiring assessments all over the world to fill data science, data engineering jobs. And then on the back side of that, we also have an upskilling platform. And so not upskilling in the way, we all think of training and we think of it as this kind of one-time event. So if I need to learn, I'm going to go to training and I'm going to do this one time and I'm going to learn everything I need to learn and everything's going to be great, when we all know it doesn't really work that way. And so we have a much more of a micro learning platform that leverages assessments to figure out the gaps in skill sets. And then we recommend bite-sized learning opportunities and that type of thing, and allows you to sort of learn in the flow of work. We have a Slack bot where these learning resources are presented in front of people as they're in the flow of work every day. And so between upskilling and the hiring side with our assessments, that's where we're kind of helping organizations really grow that kind of data talent, because it's not enough to just be hiring well. There has to be some upskilling in order to get there. And so with that being said, we're excited to be here and really looking forward to the panel today. You can find us at quanthub.com. I think our name's probably in the show notes or whatever. Q as in quant, which actually came from FinTech. So it's a good fit for us today, and we're looking forward to the topic.
Thanks, Matt. And I also want to thank our exhibiting sponsor, TIBCO, who's also been a longtime friend of Data Science Connect and the Southeastern Data Science community, and now the global data science community. So thank you to Mallory Tate at TIBCO. And we'll include a sort of a grab bag of sorts, a virtual grab bag for the attendees with digital takeaways from today and other articles and good stuff that you guys might enjoy as well. A couple more announcements before we get started. Registration is now live for our virtual data science conference this fall, and it will now be for 4 days, featuring 4 tracks. The first 2 days will be workshop driven, and the last 2 will focus on presentations and panels. And the conference dates are October 6th through 9th. And we are giving all attendees today a special offer of 40% off using the code FinTech40. And we'll include this in the post-event blast as well as more details on speaking and sponsoring. Today, however, we're gathered to focus on how data science and advanced analytics are at the core of the current transformation of the financial sector. I read the other day that over 40% of data science jobs are actually in the FinTech industry, which was very interesting, and I didn't know that before. And FinTech is also unique in that it has always had a structured data set that many of you can speak to, leveraging for long before data science was really a household term. So we look forward to hearing from all of you and all of your sort of individual perspectives within the industry. Throughout today's conversation, when you have a question, use the Ask a Question button. It'll be at the bottom of your screen, and then upvote for the ones that you want us to address. And now, let's hear from our expert panel. Rishti Gupta is a data scientist at BlackRock and joins us from New York City. Marcus Martin is the co-founder and CEO at Anchor Digital and is in Charlottesville, Virginia. Abhishek Brazia is head of intelligent automation, tech, and transformation at Fiserv, and he's located right here in Atlanta, Georgia. Carolina Hoffman-Becking is a senior strategist of artificial intelligence and innovation at Ernst & Young and joins us from Hong Kong. Carolina, I already told the audience, you want to tell them what time it is in Hong Kong?
It's 5 a.m. Yeah, good morning, everyone.
Good morning. Akshay Fanayak is the Associate Director of Credit Risk Modeling at UBS and joins us from New York. And where Carolina is just starting her day, Avihai Nathan is the Senior Director of Data Science at PayPal and is ending his day in Israel at a little past midnight. And last but not least, repeat speaker at Data Science Connect, Dr. Rajkumar Bondugula is the Principal Data Scientist and Senior Director at Equifax and joins us from Atlanta, Georgia, where DSC is headquartered. So we'll kick things off like we always do with each of you telling us a little bit about your backgrounds, as well as why and how you are currently using data science in fintech. Shrishti, let's start with you.
Yeah, sure. Hi, everyone. My name is Rishti Gupta. Thank you once again, Amelia, for having us here. I think it's a great platform to connect with all the analytics enthusiasts out there and share our thoughts and experiences. So talking about my background, I'm a data scientist by education as well as by profession. I pursued master's in business analytics from MIT. Currently, I'm working in the risk analytics division of BlackRock. And for those of you who don't know BlackRock, it's an asset management firm. My team stays at the central part in the firm where we provide data-driven solutions to other teams in the company. And it is aimed at minimizing the risk at the same time, improving the lending and the trading activities of the firm. I personally work with strategy teams to provide analytical solutions for better execution of trades, management of liquidity, and monitoring health of lending practices of the business. Prior to working with BlackRock, I worked with MasterCard as the analytics consultant. So I worked with different clients and helped them better understanding the spending patterns of their customers and driving loyalty behaviors from that. Thank you.
Thanks, Shrishti. Marcus, how about you go next?
Thank you, Amelia. Thank you for the panel. It's an incredible panel and very honored to be a part. So my name is Marcus Martin. As Amelia mentioned, I'm in Charlottesville, Virginia. And I'm probably one of the few on the panel, I guess, that's more on the executive side. My background is mostly in capital markets, as well as a blend of sort of blockchain analytics and research, as well as software development. The company that I'm representing tonight, Anchor Digital, we effectively took a view across the disparate marketplaces in the blockchain protocol universe, created a software solution that effectively wraps across all of the more active blockchain protocols. So any asset creation, trading, mining, or any other activity that's created on chain or across most of the major exchanges, our software solutions take that data and we store it securely for each individual business enterprise that may be using blockchain technology for internal optimization or customer-facing product solutions. We provide this layer which allows you to effectively reconcile any transactions, reconcile any ownership, also provides you compliance and surveillance as well as tax tools. So it's we are a little early in the marketplace given where the regulatory environment is, but just recognizing where the universe is going, we've decided that we would get ahead of the game, I think, and build something that really bridges the gap between what Web 2 and Web 3 looks like. As far as data science is concerned, as you can imagine, when you pool all of this data, there are plenty of required tools to actually apply this, sift through and provide the accurate, valid data sets to each individual enterprise, regardless of what industry they're in. Obviously, the most widely used solution or client that would use our solution is in fintech, financial services. My personal background is also in compliance and infrastructure. So I've spent a lot of time working across global emerging and frontier markets on the structured product side within multiple compliance and jurisdictions. So we've taken a lot of that expertise and built this sort of Web 2, Web 3 solution that deploys a lot of data science effectively to provide accurate data, reconcilable data, surveillable data. And thank you again for having me here.
Thanks, Marcus. And we're especially excited to have you at we had a blockchain workshop at our conferences this past fall, and the blockchain workshop folks got there and they were like, wait, this is a data science conference? Like, what is data science? So I'm excited to start to bridge those two worlds. And I know we talked about that recently as well. Abhishek, want to go next?
Hi, everyone. This is Abhishek Brazia. Thanks for having me. This is my first time on this forum, so really glad to join and looking forward to the discussion. My background is mostly strategy consulting and business transformation. I pivoted towards data science, intelligent automation, and artificial intelligence around 5 years back. And I set up the Center of Excellence for Intelligent Automation for another company here in Atlanta called Assurant. Right now, I am at Fiserv, and my team's charter is to help businesses identify transformation opportunities, both internally as well as on the product side, using intelligent automation and artificial intelligence. So, I call it IA to AI and everything in between. But the approach that we take is very much a holistic business consulting approach where, a combination of process engineering, digitization, and data science combined together to transform the product experience or internal operations with needle moving impact on the bottom line. Glad to be here.
Thanks, Abhishek. Carolina, you want to go next?
Sure. Yeah, thank you, Amelia, for having me. I'm a senior strategist at EY here in Hong Kong, and I'm also a subject matter expert for machine learning for Asia, and I predominantly serve our wealth and asset management clients. And this is, as you could think of, a typical consulting role, really educating clients on AI to get a bit more beyond the perception of it just being this black box that they can't grasp, and really show how what a powerful enabler it can be to our clients' business. I'm also the founder of an early stage AI research company. So this topic really became a passion, and it's kind of the ultimate thing I could have dreamed of to work on as an engineer. Yeah.
Thank you. Akshata, you want to go next?
Sure. Thanks. First of all, thanks, Amelia, for this opportunity to be on this forum. Hi, everyone. I'm Akshay Fanayak. I work as an associate director at UBS. I hold a double master's degree when it comes to education, one in statistics and the other in business analytics and project management from UConn. In my current role, I deal with credit risk models, particularly for the global hedge funds and private equities portfolio. I specialize in various data mining techniques, supervised and unsupervised machine learning techniques, and model risk management. I've handled in my past experience my forte of experience spans from investment banking, retail banking, corporate banking, and a lot of my experience goes on regulatory projects, which are around IFRS 9, CCAR, Basel, CECL, and so on. On a day-to-day basis, I work with various cross-functional teams such as the business risk, enterprise, financial risk, AML regulators, and in accordance to the various policy guidelines. And in each of these spaces, there's plenty of opportunity and space for ML and applications of various ML techniques. In my overall experience, I covered the overall customer life cycle in the space of credit risk. Thanks again for having me here.
Thanks. Avi, you want to go next?
Sure. Thanks, Amelia. Hi, everyone. First, I want to say thanks again for being invited to this forum. I'm honored to be among these great people sitting next to me on the panel. So I'm Avichai. I'm based out of Israel, and I'm a senior director of data science at PayPal. I'm coming from a background of engineering and business administration. And actually, I've been working at PayPal for the last 9 years, starting as a junior IC and reaching to a position of senior director. So that's been quite a career journey for me at PayPal in the area of data science all the way. I'm working at our global data sciences organization at PayPal, which is a huge organization of hundreds of data scientists and engineers who are tackling day-to-day problem at PayPal at every level of interest the company has, from fraud prevention to compliance to sales and marketing. One of the really cool things about working for PayPal in data science is that it's really integrated into the everyday work of the company. There's hardly any subject at PayPal which we don't touch and help the company move forward. And I'm personally very honored and very engaged to work at a place where you can actually feel your work creating impact and creating a lot of positive outcomes for the company and also for the many people that we are proud to serve. In my current position, I'm leading a global group of what we call horizontal data science and advanced AI. My team is responsible for tackling some of the long-term problems that we face as PayPal in the data science areas, the problems that we need to tackle holistically by building sustainable infra that requires multiple investments. So my teams across the globe are actually taking that and building this stuff for our data scientists and for our customers, as well as researching 2-3 years into the future on what will be the future of AI for us and what techniques and models should we start investing in so we can gain the benefits into the future. So as I think I'm I feel the same as Carolina. I'm working at my dream job, basically, even when it's midnight, a bit past midnight, but still, again, very honored to be here and thanks for having me.
Thanks, Avi. Hi. Raj, you want to go last?
Sure. Thank you, Amelia. Thank you for inviting me to be on the panel. Hello, everybody. I'm Raj Pandubula. At Equifax, I run a small data science team, and our team is part of Equifax Innovation Office. And the charter of my team is to work on solutions that will bring us revenue in 3 to 5 years. Basically, we focus on medium to long term as well. And my team deals with anything to do with first of all, machine learning, natural language processing, and distributed computing. So I was very fortunate enough to study machine learning and big data, both in my master's and PhD. So lucky, I was fortunate to have specialized in grad school. And also since then, I was also fortunate to work on those technologies in Department of Defense, at Sears, and also at Home Depot. Those are my prior roles before I came to Equifax. And I'm looking forward to the discussion we are going to have here today.
Thanks, Raj. So to get started, unlike many industries, like I mentioned before, Fintech has been leveraging structured data for decades. Increased processing powers and increasingly sophisticated data models are, however, enabling innovative solutions such as robo-advisors and automated fraud detection, enhanced credit risk evaluation, and portfolio optimization, just to name a handful. Shrishti, let's start with you. How do you see data science transforming Fintech, and what do you think are the biggest obstacles to that transformation?
Yeah, I can get started. So just echoing on Amelia's point, Fintech is one of the very few industries in the world which has been leveraging analytics for decades. And the industry was primarily driven by economists and mathematicians, because of which it has seen very early on signs of usage of data science practices like data collection or building models, etc. What has changed right now is the availability and decrease in cost of computational power. Because of the availability of large data sources, we are able to leverage large amount of data to make predictions for the future. And the ability to run sophisticated models real quickly is allowing the data science practitioners to iterate over quickly, thereby expediting the feedback loop cycle. The transformation that data science is bringing to the Fintech industry includes, but is not limited to better fraud detection techniques through worldwide collaboration, or better risk modeling through usage of different data sources, prediction of stock market pricing through usage of deep learning, etc. Moving on to talking about the obstacles that are being faced in this transformation. From my experience, I feel one of the biggest obstacles has been apprehension around acceptance of data science solutions. We know that some of the data science models out there perform very well, but then they lack interpretability and behave as black box. The problem comes when a data scientist fails to answer the question, why do you think this model is giving this result, or why is it behaving this way? Well, this is a fair question to ask because the stakes are real high and a lot of money is involved in this. And I think the way to mitigate is by making our models more interpretable so that people will be able to understand it better.
Any other thoughts on that?
Yeah, another thing that changed, in addition to everything that Rishti said, is the expectation. So in the past, in Equifax, when we built risk models, we used to use about 50,000, 60,000 data points. We started building models using 2 million, 3 million data points. My team is working on algorithms today. We build models using 200 million data points now. So the technology, the sheer algorithmic complexity. So we just recently cranked some numbers. So to run that algorithm, it took us 76 quadrillion computations. Okay, so that's the kind of complexity that we're talking about today. And today our customers are demanding it. Like when people have bigger and bigger, like Srishti was saying, right? Like a lot of data is available, a lot of clusters are available. So why not? Let's push machine learning all the way, right? And see what happens.
Yeah, I'd like to add on that. I think
So,
that
shifting. Sorry, go ahead.
Yeah, just one thought. I think that as we're thinking about data science, and I think Raj made a great point about the numbers. It's really becoming a game of not just going to the data set and running the algorithms the way you used to think about them, because the complexity and the amount of data will just explode your computation and your storage. So it's really about more like a multidisciplinary thought process of how do you optimize, what is your hardware, what is your storage, and coming up with an iterative process that makes sure that you're doing what you need to do, but not overloading your capacity. And really, we're seeing at PayPal many thoughts and processes about how do we buy the right hardware, how do we plan for the right storage, and what do we not do, because we know it will bring X impact, but will cost us 5X at computation and storage. So I think this is also something that's really important to think about when you're doing this kind of thinking.
So cryptocurrency and blockchain has been a sort of a new buzzword for the fintech community. Marcus, you're an expert and advocate of blockchain and cryptocurrency. As we talk about the importance of data in understanding and facilitating financial transactions, cryptocurrency seems like the ultimate evolution to that, in that the data itself is the transaction and functions as a form of currency. What are the barriers and solutions around the institutional adoption of digital assets for consumer markets?
Well, so I guess there's a couple ways to break it down. I think to talk to Dr. Raj and Avi and Sristi's comments, the biggest barrier to the use of blockchain technology is the scalability. So being able to process the data set, the sizes of packages that we're talking about is just, it's extreme. I think when we take a step back and we look at the ability for, let's just use the word digital finance or blockchain rather than cryptocurrency, to represent ownership, to represent certain aspects of assets within the life cycle of capital markets or in the fintech universe, what you end up having is the ability, if you can package this accurately and scale it, a better way to surveil it. So actually, I think once we get to a point where the fear of what blockchain technology provides, when you look at public chains, being able to actually scale public chains is incredibly valuable to the continued development of capital markets for fintech. It will allow us to unlock what we would call trapped asset value, things like real estate, commodities, larger assets that trade in larger block value where you can break those down. But to be able to manage and monitor all this from a compliance perspective, what the industry really needs is a set of regulations around digital finance, not regulations that fit the model for securities that currently exist, like equities or fixed income or any derivatives thereof. The biggest hurdle is legislation that allows for us to leverage these digital finance tools to provide that extension, I think, for some of these activities that Avi or Dr. Raj mentioned, we can then actually surveil all of this in real time and allow for better communication. I think that that hurdle in terms of where we go for consumer adoption really lives with the hurdle that exists on the corporate side. A lot of internal optimization is occurring with blockchain technology, but you don't really see a lot of external consumer facing product. And that's because there's just no regulations to actually guide where corporates and financial institutions would go with new product. So not to go off topic from where we are with data science, I still strongly believe that once we get to the point where there are regulations in place to govern the idea of representing your Ford vehicle, your Ford ownership, the vehicle of your the ownership of your Ford vehicle in a non-fungible token, you still need to have a marketplace to trade it. You need rules and regulations around that trading. You need the ability to report it. And you need the ability, of course, to surveil all of that for anti-money laundering and other issues. So I think we're a long way away, unfortunately, from that place. But I think as we stand today, it's really the scaling issue that's mostly holding back, I think, a lot of the use case for the technology.
One quick thought to that, Marcus, is last year we actually tried blockchain in, like, we wanted to design the exchange, like create exchange of tomorrow, basically, like how does Equifax look like in 5 years, right? So we wanted to do that, and we actually implemented blockchain. One of the biggest challenges that I found is scaling, but from a different sense, right? So today, many blockchains, the fundamental way of adding to a blockchain is proof of work. So unfortunately, with proof of work, you're only able to do about 6 transactions per second or per minute. I got the wrong, but what is actually needed is close to 3,000 transactions per second or something like that. So there is like this, people are moving to proof of stake, but it's not there yet. Like not in many implementations, it's not there yet. So in addition to all the barriers that you're talking about, Marcus, there are also technological barriers that are still we need to overcome.
Very true. Thank you, Dr. Raj.
So we live in an increasingly mobile society, particularly with banking now, thank goodness. And that's even more true in COVID-19, where folks are having no face-to-face interactions to accomplish their financial transactions. What does the future of automation and fintech look like in this new environment? Abhishek?
Sure. So I think, the digital agenda of the fintech always had that we will have to move towards cashless society. We will move towards, more contactless payments and stuff like that. But that agenda was probably, a few years long. And what COVID has done, it compressed it in a few months. And what you're seeing in the market is companies like PayPal that we have representative from and Square being written about every day in terms of what's happening to their stock price with, Venmo and Cash App. And I think what fintech, if you look at fintech, kind of especially from a Fiserv perspective, we are essentially, we have a B2B side of the business and B2C side of the business. On the B2B side, I think in my personal view, the biggest and most interesting opportunity is how do we enable our customers, our clients, and who have their own end customers to become digital very, very fast, like SMB market, right? And I think what Amazon did to the computing stack with AWS, that you can build a website sitting in your home and all of that, is what needs to happen through fintech or through other means. I don't know who will be the catalyst in doing that providing a small and medium-sized business all the capabilities to become digital extremely fast. And the way I think about it is there is a stack that needs to be built. There is, of course, a transaction layer of that stack, which already is there, so that the businesses can take all kinds of different currencies and cards. But there needs to be other layers that needs to be added to that. So you have the marketing layer, which Square is doing a little bit on, which is a business can market itself through social marketing platforms, which they don't have to be knowledgeable about how to do that. They just switch on that layer of the stack, and their business is now tapping into targeted marketing, targeting promotions, and all of that. The third layer after that is the logistics layer, which is around delivery, home delivery of services and home delivery of goods, and both forward logistics and backward logistics, that they can switch on that module and they have ability of the logistics. The layer after that is more finance and accounting layer, where your payroll and everything is being provided, and then there is other layers like operations, that inventory management and other things. The point I'm making is someone needs to provide a one-stop shop to the small and medium-sized businesses to become digitally extremely fast. Fintech is in a very interesting space there, because Fintech already has a relationship with them, right? We have given them a point of sales equipment, and they are on we are processing their transactions. And when you combine the data that you generate from all of these layers, it becomes an extremely interesting opportunity to completely kind of transform those small and medium-sized businesses to become a powerhouse all of a sudden, that they have all the fundamental capabilities of a digital enterprise. Their website is up and running, at a click of a button, their website is automatically targeting the right customers by doing data mining, putting that on the right platform to promote to that target, whether it's Twitter, whether it's whichever other medium, Instagram or wherever, and then creating the finance and accounting behind it, and all of those, and the logistics and everything else. I think these layers of these stacks are available as point solution, an orchestration layer that connects these point solutions and monetize on that data to create the insights for those businesses. Whoever cracks that secret, that's kind of creative code, is going to benefit tremendously. And data science, AI, ML, all of these predictive, prescriptive models are going to play an extremely important role in that process.
And the challenge there is getting all of these, it reminds me of healthcare, is getting all these systems to talk to one another. They all kind of speak different languages right now. And so
yeah, that is a big challenge, right? And that's why you kind of start with something simple. And that's why there's a whole concept of the closed loop versus open loop, right? With Visa, MasterCard, when you are working in that network, you don't have really end-to-end view of what's happening. But a lot of closed loop networks don't have that challenge to begin with. And so I think even providing some basic level automation and digitization opportunities of this stack, and starting somewhere in the stack and then keep adding those layers, I think in the next 1.5 to 2 years, we will find that somebody is going to be the predominant player in this space.
So this is one small point that I would like to make, Abhishek, is there is certainly the digital infrastructure aspect to it, but there's also human element to it. What I mean by that one is last year or 2 years ago, Prime Minister Modi of India, he devalued 2,000 rupee notes, and majority of the currency, suddenly a lot of transactions shifted digital. But once that the supply has been restored, people reverted back to cash society. So there was an opportunity for India to switch, but somehow they never bothered to go there. So similarly, we have to see, let's see what happens here. Like when, because of COVID, I think there are companies that switch there, but let's see if they actually stick there and continue to be there, as opposed to reverting back to cash society.
So I think India is a peculiar case, right? 70% of the Indian economy was running in this parallel economy before the demonetization. And, they were forced to move into the cashless society, right? Cash wasn't a matter of convenience only. Tax was, with all due respect, a matter of tax evasion. I think US is principally a different society. Cash is more, a matter of convenience. I'm not saying 100%, but in most cases, it's a matter of convenience. And so I think the adoption in a developed country, which does not have a 70% parallel economy versus which has probably 10% parallel economy versus a country which has 70% parallel economy, this kind of sudden shock that was given will have a much different impact in the long run.
I'd like to add one more perspective on this. Thanks. So I think that we took this discussion on automation to the SMB, which is great. I really feel that we also need to think about the common people, right? We need to use, and I think the India example is a great example. They want to use their money without cash, right? And we, in the fintech world, we need to make it easier for them, because it's not going to be easier. It's not going to be integrated into their day-to-day life. That's not going to work, and they will just revert back. So as we think about automation, again, as a fintech company, we really need to think not just about the transaction. We need to think about, I think, as Abhishek said, about the marketing, about the customer service, about making sure that you can speak digitally to the right person, whether it's through chatbots technology or through some other form of automation. And because at the end of the day, all of these functions that used to do this are also people that are affected by COVID, right? And me personally, if I have something about my money, I want to get a response fast, or I'm just going to use cash, right? So I think as we think about automation, we really need to think about the entire stack in fintech, not just about the payment processing or the transaction. And the second thing is that we are all, as companies, we need to be thinking about the data science that we need to develop to make sure that we support this automation. So if we're talking about stuff like ethical AI or explainable AI, to make sure that we know how to explain these decisions that we're taking in automation and not just taking them, I think that's going to be a huge part in making this happen. Because if we're not going to be doing this as a community, that's when the regulators are going to come and say, hey, you guys cannot be fully automatic because you cannot explain ethically or logically your decisions. So I think there's a huge buzz across the industry around this right now. Many companies are trying to do that. And I really believe that the people who can do what Abhishek says, plus will have that layer of explainability and just making it ethical, I think those will be the companies that will have the winner.
And it does remind me a lot of, I think there's a lot of parallels between fintech and healthcare, in that the security and the privacy is next to our health and our personal health records. Arguably, I think our financial health and what's attached to that from a financial perspective is very sensitive in nature. And so finding that one-stop shop solution is going to be, I think, a similar challenge to what healthcare is facing with sort of housing electronic health records and creating more of a closed loop, as Abhishek said. Switching course a little bit, let's talk about investment management. Wealth management folks are constantly looking for an edge in the market. Carolina, how do you think data and AI are allowing portfolio managers to exploit alternative ways of generating alpha in the market? And what new fintech companies do you see arising from this trend?
Thank you, Amelia. Yeah, this is a very interesting question. It's indeed a very hot topic here in Hong Kong as a global financial center. And overall, in the bigger picture, we've seen a tremendous shift in the asset management industry from kind of active management to passive products, right? And this is possible today through very sophisticated, kind of factor models that seek to uncover, certain factor constellations that have outperformed the market historically, over the past 20, 30, or 40 years. And these factors are either, our fundamental factors that we're very familiar with, such as market cap, profitability, capex, and the like. But we're also now seeing a trend, tremendous trend towards alternative data. And I assume, we've all heard about companies looking at satellite images. In fact, there's a US fintech called Kairos, and they launched a product called Crude Oil Intelligence. So they leverage satellite imagery to analyze the crude oil inventories worldwide. And this is really great stuff, and this is possible today because one, as Srishti mentioned, the enormous upgrade in computing power, and images are highly computationally expensive. So you need that to be able to process satellite images. And on the other side, also the algorithmic advancements in the field of image recognition. So now we'll use convolutional neural networks to process those images or videos and the like. And other alternative data sets are like Twitter posts, right, or social media content or news data to derive a sentiment and quantify the kind of positive and negative momentum in a way, for either a specific company or industry or, country on a macro level. And yeah, another one is on, well, China provides a, let's say, favorable market environment for buying and analyzing mobile data. So there's another company based out of Hangzhou called Xiwei, and they run insights on, for example, China mobile data, right? They also have a product on production sales index, so they track daily truck drive activities from company-specific factories and their warehouses, right? And the list goes on. So this is a really, exciting field, and one of the reasons why, a quant fund like Renaissance Technology today has over, 110 billion in AUM. And so yeah, I mean, look forward to discussing more of you if you have any more questions, but this is kind of a little touch on what's happening on the alternative data side.
Which could probably be all of these subtopics could be conversations in them or panels of their own. What you point out about sentiment analysis is interesting to me, as what we even see currently. I think our president, Donald Trump, can tweet and get a positive or negative reaction, and the stock market flies up or down. And so I think there's even a little bit in terms of monetizing that. There's getting ahead of that sentiment analysis and figuring out where the stock market's going could be
yeah, I mean, this is very frustrating for, fundamental investors, and then they do all their analysis and they're extremely experienced, and then the market, gets moved by a Trump Twitter post. So absolutely, and that kind of shows those, very conservative, traditional long-only funds to kind of adopt a quant approach as well. And they get asked by their investors, what is your quant approach? What kind of alternative data sets are you looking at? And everyone in the industry needs to stay relevant, even those investment managers. And yeah, so you're absolutely right. That's, investing is hard. So they try to get their hands on good data.
May I add in, that concerns me as well in terms of how much scope for manipulation that leaves, right? So if you have satellite imagery trying to predict the warehouse movement, I will just have empty trucks coming in and out of my warehouse just so that my stock can go up. I'm just making a wild kind of exaggeration to make my point. Or you have political parties creating deep fake. So I think what AI is doing is opening up this whole opportunity for manipulation, which I believe in the next few years will also create a huge demand for curated stuff, which is a non-AI curation of authentic stuff, and it's happening in news, right? A curated news is much better than and people are even using AI to kind of filter out the fake things. And so I think it's a very interesting kind of there is a duality to this, that on the one hand it's becoming better, but then that also gives some of the smarter people with more resources a greater ability to send the right Twitter post so that their stock price can go up.
Yeah, Abhishek, and I wanted to chime in because there's no doubt part of my earlier career was working in emerging markets with a lot of global hedge funds and alternative asset managers. And as early as probably 10 years ago, I recall some of the more sophisticated hedge funds using sentiment analysis across particularly the Middle East. And you often wondered how much of that.
Did we lose Marcus? Or is that just me?
I think, yeah, I think we lost Marcus.
Okay. Marcus, come back. So, finish what we think.
It's a shame. I wanted to hear his thoughts.
He started to talk about the Middle East, and that's it. That's
And then everything got shut. I know, that's sort of the sentiment of the day. How we started, and here we are now. Yep, but we've lost Marcus for good for now. I'm sure he'll rejoin us shortly. But
while we lost Marcus for the while till he comes back, the other point I'd like to just add is that's why, instead of a bell curve, things have become U curve, right, or a backed up curve, right? So you have people on extremes on pretty much everything, right? Because you're fed the kind of information that you want to receive, and the more you kind of, if I YouTube certain videos, I get more of that kind of videos. If I YouTube certain things, I get. So what's happening is it's reinforcing my biases. So that's kind of creating this polar world instead of the bell curve world that was in the era of where I'm not getting curated information. Where I was getting kind of general information, not customized for me. That's what I think is a big difference between what AI's downside is on some of these things.
Marcus.
There's also a downside to not being hardwired and being on a Wi-Fi connection. And I think I just experienced that. I don't know where I got disconnected, but I think my point was just simply the manipulation in these emerging and frontier markets is very real. On the capital markets, what we were talking about, Abhishek, in these less liquid markets where you can tweet something, follow sentiment, and push the markets even further. There's without a doubt, based on sort of the work that I've done, that exists. I think in the more liquid markets, in the larger markets like the developed markets, it's a lot harder because the liquidity is vast. I don't know where I disconnected, but I appreciate you letting me chime back in there.
So, Akshata, you've spent years building models around credit risk, which is, as you've mentioned previously, very niche. How is that changing as we have larger volumes of data and the increased capacity to process and leverage that data? And how has that made your models more sophisticated and accurate?
Sure. Thanks, Amelia. So I'd like to start off with mentioning that credit risk is probably one of the more established fortes within the bank. You have many of these roles and many of these overall responsibilities carved out based on the various regulations that came in post the 2008 crisis. So because it mandates regulatory guidance, I think banks have had this overall structure very much in place. But that being said, credit risk plays a role in various stages. So right from planning and operations to providing strategic insights to businesses, coming up with the final business rules when it comes to different portfolios, identifying the kind of risks that you might have with respect to certain portfolios versus others, and trying to mitigate all of these losses. Also, credit risk plays an important role even in some of the forecasting models, wherein you want to forecast the kind of revenue you'd have going ahead, the losses you have. And also, as I started off with, it's all based on regulatory guidelines. So definitely there's a lot of monitoring and regulatory reporting there. How this has evolved over time is, I'd say, by the use of more sophisticated models, we are able to move to more cloud technologies to enable, a more robust big data infrastructure within the banks. More and more banks are you no longer see them using legacy systems, and I think that's the general picture initially you would get as a bank. But I think they're evolving with the more sophisticated use of technology, and this definitely helps in pushing out models which are based on more sophisticated algorithms. You're not heavily dependent on the simple logistic or linear regression which you would have started off at, but I think today you see a lot of neural networks and some of the more difficult to implement models. I think, as Rishti and Carolina and some of the others touched upon, like, nobody wants to have a black box model, but when it comes to some of the marketing strategies of the bank, or when you try to extend credit for the first time to certain customers, I think you can have your strategies based on the application of these various algorithms. Totally increases the accuracy of your models. It helps you have a better portfolio as a bank. Also, beside that, I think based on the riskiness of various portfolios, there comes into play the pricing models, wherein you'd like to price your various products, instruments more effectively, so that you make sure that if you have a high risk, high volatile portfolio, high returns portfolio, definitely, then your customers pay a high price in that effect, because that's the risk that it comes with. And also, I think some of in order to make sure that these continue to be robust, I think with the credit risk perspective, you have a lot of these stress testing scenarios, because you need to make sure that the capital you've set aside is sufficient, especially in scenarios such as the COVID or any of the other financial crises, macro reasons. So you need to make sure that the kind of capital you set aside to protect the bank and the customers against such risks are totally going to be covered on this front. So I think that's how I'd summarize, the overall applications currently, how we're advancing because of the overall infrastructure. We're able to implement models with higher sophistication, and there used to be a trade-off between the time to implement these models. You wouldn't want to implement extremely sophisticated models with the risk that the customer faces a kind of discomfort at the final point of contact. But given the kind of computing that's possible and is continuously evolving, I think that's we can move towards more accurate models without much of a trade-off on the time spent.
In addition to what Akshita was saying, so I'll give slightly from a credit bureau point of view. So one of the reasons why not much happened in the fintech space, actually in the credit risk space for the last 50 years or so, is because, like everybody said, we are in a heavy regulated space. So the question is, logistic regression is probably the easiest way. You can easily explain the model and things like that. Now the challenge with that one is, as the data availability increases, the accuracy of logistic models doesn't go up. After a certain point, it plateaus. And the reason that happens is it's what is known as a representational capacity. It has a limited representational capacity. So the advantage of more sophisticated models, such as neural network, is that it has an order of magnitude more representational capacity. So the question is, how do we tweak the neural network in such a way that it not only gives you a better performance, but it will also give you reason code? So Equifax has invested a lot of time and effort into this. We've introduced some products where we were able to, again, like I said, like in the initially when people were using logistic regression, it was only 50, 60,000 data points. And now with neural networks, we're talking 5 to 6 million data points to train a typical model. And we are seeing the benefits of that one. So in addition to neural networks, we're also using other sophisticated, like we're using XGBoost and we're using random forest. And I just alluded to another point earlier is because why stop at 6 million? Right. So the question is, it's unlikely that 6 million people represent the entire U.S. population. So there are about 200 million people with active credit file in U.S. And so the question is, are we saying the 6 million people represent 200 million people? Right. Like in the era of big data, I don't know if that is a good assumption. Right. So what we do is like, okay, why can't we use this entire 200 million people? Right. So we are actively thinking about that one, and we are seeing the benefits of those efforts as well. And in addition, like we are also seeing these benefits in other areas of our business, such as marketing. We are able to do much more accurate. We are able to hone in into much more homogeneous groups of people. We are also able to build much more accurate fraud models as well.
Thanks, Raj. So just to add, you added really great points about volumes of data which has increased. I'd say another very important point when making sure you have data which is representative, because in certain portfolios we face the lack of data. So I think the right sampling strategies are very key here within credit risk model. Sometimes we just rely on external data. So making sure that the type of data that you're actually utilizing and should give you maximum accuracy. I think choosing the right sampling strategies is key here, making it the best representative of your data. And I think as our models keep getting accurate and evolving, we face the lack of data, because thereon you see that you have lower defaults in your portfolio. So how do you enhance your portfolio? How do you enhance your models even better? So I think that's where some of the undersampling and oversampling techniques play a key role.
To what Rajkumar was just talking about, is it also correct, and this is more of a question than an opinion, that in this world that we have been living in so far, we describe a person's creditworthiness as one number, right? But that should not be the case, right? We should be able to describe different dimensions of a person's creditworthiness. So what's my likelihood of paying for my vacation versus paying for my mortgage may be very different. So one thing is, like, we have more data, and there may be a point where we plateau in terms of the accuracy or incremental improvement in accuracy of providing that one number. But now if I'm providing 20 different aspects, 20 different dimensions of a person's, whatever it is, and then having the 200 million data points or 200 million people's data points may be more required for that reason. So I think there is also a change in demand that we may see. Am I thinking correctly? Is that a fair statement?
Yeah, that's exactly correct, Abhishek. See what happened in US again. Like there are about 40 to 60 million people who don't have credit data at all. They're underbanked people. They don't have any data at all. So then we are actively thinking about how do we enable credit to these people, and not just in the US scale. Equifax operates in 24 countries. Okay, so overall over the world, I think currently about 800 million people have access to credit. So our thinking is, how do we make credit available to next billion people? Okay, in other words, how do we double the economic activity of the world? So the question is, like, how do we do that? So that's exactly right. So we've invested in a lot of companies that give us alternative data. For example, we host an exchange called NCTUE. In other words, we have your billing information, like your information about your utilities, your your cell phone, your internet. We have all that information. So the question is, today, because of contractual obligations, we cannot use that data. So once we are in a position where we are able to actively convince our furnisher, saying that, hey, can you please let us use this data so that we can enable credit to other people. Right, so I think that is an active area, and we are actively thinking about that, especially in US, in countries like India, in Russia. We have like many areas going on. We are trying to see what other information can be used? Like, can we use your education, for example? Can we use your income, other income, your investment income, for example? So we are looking at that particular problem from all angles.
Raj, who would be the consumer of that modern credit rating or score, the process that you're talking about? I'm just thinking about it because it's fascinating. Obviously, from the blockchain world, I think of the unbanked. And so I wonder how you bring financial services products to the unbanked, but do it in the current regulatory environment. And to me, just the Clinko ball process doesn't look like it works. So I'm curious to see from your side, how do you see that?
So a couple of, one thing is we actively work with regulators. So we actually go convince them, hey, like, this is what we are doing. This is how we are trying to help people. That is number one. And number two, again, Equifax operates in 24 countries. We don't have to necessarily start in US. We can actually start in other countries where we don't have this kind of regulatory burden. So I mean, again, regulations are two double-edged sword, right? Like in some sense, they protect customers, but at the same time, they also are a barrier to advancement of a lot of things.
I would say that they protect us against fraud, but they inhibit us towards innovation.
But it's also a matter of like, it's up to me, right? I mean, as a credit provider or as a lender, I can decide to take a risk on something. I say, well, I'll take my chances on this, right? And, I'm not going to use, I'm just making a general point that I'm not going to use a credit score from Equifax. I will use the Twitter star rating, whatever it is, right, to make my decision. And so one is, that there is no regulation as such, right? Or what Square did, like, I'm going to give people, allow them to take credit card, and I will not go through the whole regulatory process of 2 months to get them to to allow them to swipe a card. I'll just give it to them, and gradually, initially, we will just give them $50 limit, and then 100, then 500, and whatever, and we'll keep increasing it. So it also, if regulation doesn't keep pace with, if the purpose of regulation was to provide a value, right, that this number has a lot of value, people used it for decades. Now that number may actually not have much value. And so unless you give me a valuable information that I can use to manage my risk, I don't need your information. Is that fair?
Yep. I mean, again, that's like to your point, Abhishek. Like, when we are also getting like your rental data right now. Again, like I said, like sometimes people don't have credit reports, right? Like, but if you are paying your rent properly, that's that's as good as credit, right? Suppose like whatever $1,500 apartment that you're renting, you are very good on that obligation. So we are trying to see how we can do that. And to your other point, Abhishek, again, this is actually two of your earlier points, right? So we thought of looking into social media and other things, but the challenge is exactly what you said. It's very easy to manipulate that information. It's very easy. So there were some studies done by some universities. They were saying that if they simulated the notion of using your social media information, and the moment participants realize that the social media information is being used to do your credit, the structure of the network seems to change. So even consciously and unconsciously, they're manipulating it. So we have to be extremely careful that the data that goes in has to have a cause and effect relationship. Like, for example, the extreme example would be knowing the flavor of my favorite ice cream is not necessarily useful in credit, right? So that's what we actively think about as well.
What is the favorite flavor? What is your favorite flavor of ice cream?
I like all ice cream.
Good answer. So Akshata mentioned the challenges with sampling briefly. Abhishek, in dealing with fintech transactions, you're often dealing with imbalanced data where there are a disproportionate ratio of observations in each class. For all of you, let's start with Abhishek. What are some of the models or tools that you found to be effective in addressing this challenge?
Thanks, Amelia. So I think I really related to what Akash just said about the sampling, because we at PayPal dealing with unbiased kind of data sets. That's what we do, especially when we do fraud prevention. You want to find the needle in the haystack. You want to find this bad guy or bad girl who's trying to impact our customers in a sea of great people who are just trying to use payments to do their digital lives. So we've over the years made up a lot of methods and ways to actually do that in a way that is not impacting the customer experience, because the easiest thing for me and the easiest mistake you can do is actually to treat it as a normal problem, and you'll end up catching whatever you want to catch, but you'll catch a lot of bad stuff that you didn't want to catch. So we're going to decline a lot of good transaction. You're going to create a lot of friction. You're going to and again, at the end of the day, it could be someone that you care about that's sitting in a shop trying to pay and it's not working, is banging the screen against the table, and that's on us, right? At the end of the day. So I do want to offer a few tips, because obviously we cannot go into the models in this time frame, but I do want to say just a few points. So first, go back to the basics, right? When you're dealing with that kind of you need to go back to the basics. You can't assume that what you did in the past will work. So the sampling strategy, how do you oversample or undersample? You really need to give it a good hard thinking and not rush into just creating the data and start running your models on top of it. That I can guarantee will never work. Well, I don't know if never is a big word, but almost will never work. The second thing is really don't assume that what worked in the past will work now. So if you use a specific strategy, a specific method that worked in another place, that's not necessarily going to work right now, because the classes are different, the ratios are different, and the disproportionate that you just mentioned, even the slight difference in the disproportion can mean that you have to go to a different completely method. So it is something that you need to think about. The third thing that I would recommend is to know your data. And I can actually share that the first thing that my data scientists do when they approach a problem is just to know the data. And they go back and they present us the data and what do we do with it, and where is it stored, and what does it contain, and what is missing. Because I believe that the model is only as good as the data that you feed it. And especially in a case where you actually go and do unbalanced kind of data sets, you really want to find a way to magnify the signal in the smaller set. So in order to magnify, you really need to understand the data. You really need to understand what is missing, and you really need to think about, okay, what can I do more, and how can I use what I have to magnify that signal? And that can be by, as we said, sampling methods. It can be by bringing in external data. It can actually be by manually reviewing. Go to the data, look at it, examine, and try to figure out what's really going on. Don't treat that sample set as just another data set, especially when you're trying to predict something that may be a needle in a haystack. You really need to understand how a needle looks like. And what's better than to look at it with your own hands and with your own tools and really understand what you're trying to do. After you did all that, basically you got it, right? So all of these different classification techniques, looking at the precision, looking at the recall, that will make a lot more sense, because without it, you're gonna get a great solution with great precisions, great recall. They will mean absolutely nothing. And when you go and establish that in the real world, you're gonna end up causing a lot of friction and headache for your company and for the people that are working with your products. So that is like really in a nutshell, the tips and tricks. Which I think, by the way, can be applied to any data science problem as best practices. Yeah.
I would like to add to what Abhishek said, and it's more or less what he's saying, but in a slightly different word, right? So first of all, when the classes are imbalanced, so that is the assumption is that it's a multi-class classification. But problem need not be a multi-class classification. It could be a single. It could be a single class classification. So what we would do is to build a model trying to learn the class that we are interested in and try to ignore everything else. Sometimes what happens is, suppose you're trying to identify leads in a Twitter data, for example, people who are getting married. So like for Equifax, it's interesting because if you're getting married, then that means you're going to look for a house. Then if you're going to look for a house, then that means you're going to get a mortgage. And you're going to get a mortgage means you're going to run a credit report, right? So it's interesting to us. So like we looked into this problem. Then the question is, yes, like when we looked into what 10 billion tweets, the number of people who are actually getting married was about 6,000 in that particular data set. So instead of trying to model that as a dual class classification, in other words, getting married, not getting married, we trained a model just using a single class classification. In other words, my classifier just focuses on learning about people who are getting married and learns to ignore everything else. So that is like one another way. Because like what happens is that majority class need not be a homogeneous class. And if it's not a homogeneous class, and if you try to model it as a single class, then it will have a pathetic performance. That's one way. And another one way would be something like a nearest neighbor classifier. You don't have to worry about, it's not sensitive. If you have only a few data points, or let's say even let's say a couple of, depending on the problem, a nearest neighbor classifier would actually not get influenced that much by class imbalance. That is another would be, and it's more sophisticated cousin is support vector machine. So again, so there are a couple of tricks that we could use, and in addition to what Avi just said, whatever I just said also makes sense.
Yeah, I definitely agree with Raj.
Raj and
this is not working. So I just want to say I definitely agree, and I think we're saying the same thing. I do want to just comment. I think the last point that you made is extremely valuable on the classifier. But on the other end, what I don't want the audience to do is to run at every unbalanced problem and try this classifier, right? It has a lot of great things like the sensitivity, but you're losing a lot of other things. And for specific problems, it may work. For others, it may not. And I've seen this happening all the times with my junior data scientists trying the same SVM. That's like we have the code word, SVM works. It doesn't always work, right? Not anymore. So I think it's a great point, and it's a really great classifier. And again, my cautious here is really, guys, try according to your data and according to the theory, what makes sense and not necessarily what used to work. But great points. Thanks, Raj.
And Avi, I think this is a perfect segue into our last question before we hit the lightning round, and also our top voted question from Cody L in the audience. Avi, you mentioned what you advise to your junior data scientists, and I know, Raj, you've worked a lot in mentorship roles and have a large team as well. According to fintechnews.org, the banking and financial services sector is the biggest market for analytics and data science professionals, with over 44% of all jobs created in this domain. How does one prepare for a career in data science in fintech from a skills perspective? And then the add-on question from the audience are just, what are some areas that would be useful to study or read into? Raj, you want to go here?
Yep, sure. So let me attempt to share my screen. Is everybody able to see my screen?
Yes.
Okay, awesome. So I've been writing, and this is for an article that I've been writing. And one of my roles at Equifax is to think about skills transition. As you know, we are spending about $1 billion upgrading our technology stack and all our infrastructure and so on. So one of the challenges is like, how do I move our people to the contemporary technology? So I would say, so this is something that I came up with. It's called individual analytical maturity progression. Okay. So, and please remember that the amount of effort required to transition from one stage to another stage is not symmetric. It's not same. It's different. So what happens is a lot of people who first, when they first graduate, and depending on the industry, you will be in stage one. So you just have an academic degree, BS, MS, PhD. Suppose if you apply for Equifax, for example, your degrees in psychology or human resources or some area that is nothing to do with fintech in general, you would be in stage one. Okay. So then what happens is, once you, in addition to the degree, do you have some kind of training in some kind of analytical package? So for example, if you're an engineer, more often than not, you would learn MATLAB in school. And similarly, if you're a statistician, more often than not, you would learn SAS in school. And if you're a bioinformatician, you would learn R in school. Or if you are somebody who's entered as an analyst into the industry, you would learn SQL. So you would be in stage two. Then what happens is, a lot of times these tools are really good, but for a specific purpose. there are certain things, for example, SAS is good at certain things, modeling and things like that, but it's not very good at large scale data manipulation. So there will be a time where in addition to these tools, you have to know some other general purpose, a full-fledged programming language as opposed to a special package. So then I would call that person a stage 3. So sometimes people with degrees in computer science, they already know, they already have a degree. They also know general purpose programming or one or more general purpose programming language. Right? And a lot of people at Equifax happen to be in stage 2. Actually, in fact, most of them are between stage 2 and stage 3. So all this is good about 5 years ago, about 10 years ago. But now, whatever we are doing here, can we do it in a large scale? And the way you do large scale is basically now you have to know some kind of technology that will let you do large scale general purpose data manipulation. And the way you would do that is learn something like Apache Spark. SAS now entered that game using SAS Via. It used to be MapReduce, used to be the fashion. Now Spark is actually much better now. So you would have, so whatever you're able to do when you're at this stage, you'll be able to do the same things, but at a much larger scale. Again, typical for a typical Equifax job, every month our archive is about 1 terabyte. So unless you actually know some of these, it will be very hard for you actually to be productive. Okay, and once you are here, like, and as we publicly declared, like, we are actually moving to cloud now, and I think like there are some banks that are slowly moving to cloud. So the question is, whatever you are able to do on your on-prem cluster, are you able to be equally productive on a cloud environment? So that is what I would call at stage 5. So what happens is, like, depending, if you're an established organization, you would have hired a lot of people here, then you should slowly migrate them to different stages. But if you're a new organization, if you're a startup, then sometimes it makes sense to directly hire people at stage 4 and stage 5. So,
can I chime in?
Please.
And just make a quick plug. Thank you, Raj. That was fantastic. If you take it one step back before that, one of the things I didn't mention, I deal a lot in humanities with scholarships. And I particularly focus on a lot of students, diversity students. I think just before we get into any of that, early stage for anyone that's listening or that's advising, learn maths. Don't be afraid to dive in and get lost and learn maths, because what Raj just showed you is a phenomenal path, but until you have to understand all the math that's required as a sort of a baseline to get to this place. So I would just encourage those that are listening to try to force people who don't like to do their maths to do them, because otherwise all of what Raj just showed you is not really possible. And again, Amelia, thank you. And the UVA Data Sciences School is an incredible resource. So for those young people that want to go through that resource, the folks over there, Reggie Leonard, it is a premier data science school, and they are providing tools to the community to learn how to get yourself into a position to become a data scientist. So I wanted to just add that as well, because the math background and foundation is critical.
Absolutely. As a trained practitioner, I know we were talking about the other day about, I know for my aha moment, it wasn't coding, it wasn't open source tools, it was inverse matrices and graph theory and all of these aha moments that are so fundamental to the algorithms that we're driving and the models that we're building and the implications that those have. And if anyone, you can reach out to me directly about being connected with UVA Data Science School, or I'm sure Marcus will include his information as well, but we are so proud to be a partner of with the UVA School of Data Science, and a top tier school. So we're gonna, since we started a little late, we're ending a little late, but hey, COVID. So let's wrap things up with a lightning round. In a few words, what do each of you see as having the most impact within data science on FinTech? Carolina, do you want to go first?
Sure, yes. Well, Well, first of all, I think, don't get disencouraged by, math and algorithms and cloud and so on. Pick an industry you're really passionate about, and think about, problems that you want to solve in that industry, and are they, is AI and machine learning and data science a good use case to solve those problems, right? And then I think if you're passionate about the industry, it'll be easier for you to dig into the math because you have this bigger picture and driver. And it's one thing is, being an enabler to make things better. I'm truly a believer, this can make us do things better, focus on more complex issues, much more interesting for us to pick our brains on, not so much about replacement. And yeah, I think that's a huge impact. And what I really like about this is we are this, global community. If you take Python, all those open source libraries, they improve every day. So if you learn this language, you'll be on a lifelong journey, learning and improving. So this is really exciting, and I hope to get anyone who's listening on board and contribute.
I'm glad you mentioned that too, Carolina. Data science is so often everyone, how do I get into data science? How do I become a data scientist? And data science really comes alive at the intersection of an industry. And so Avi, I know you had a lot you wanted to talk about in terms of just transitioning from a different industry into data science, which is very common too. And so maybe we can take that offline, but good call on that, Carolina. That was a really good point. How about Shrishti next?
Yeah, according to me, I think the most impactful application that's going to be of analytics in this domain is probably presenting very personalized investment solutions to common people and not just probably riches. So catering to the economic capacity and the needs of a common man, and then bringing them precise solutions, I think would be a next transformation in the domain.
Interesting. Akshay, I want to go next.
Sure.
And all the women first.
Sure. So I think
I get to do that.
Yeah, I think the most impactful use of analytics, from my perspective, would be, if in the future, wherein you can isolate a particular client, make sure all the requirements of that client 360 are addressed through the application of analytics. I think that's going to be a win for all the banks. Then you have the integration of all possible data sources, like social media and like the rent information, or basically giving the customer a prime experience in the banking sector. I think that's something that would bring maximum impact. I think we have so many regulations currently around it, but as those ease, as we get into that space where banks are comfortable using more personalized information regarding the customers, and customers also ease into that frame, I think that would be a good merge of the maximum technology applications we can have when actually looking at the entire customer lifecycle.
Rashada. Avi, how you want to go next?
Sure. I think I already mentioned it, so I really believe in it. But I think the next thing that's going to be impactful is I really believe that is around explainability of AI. I feel that this is something that as AI is going more and more into our lives, things are getting more automated, and more of our day-to-day decisions are being made by AI behind the scenes, knowingly and unknowingly. and as regulators are constantly going more and more and asking questions, and we see this going on every day, like why did this person get credit? And a lot of discrimination and a lot of people wondering, hey, like what's going on here? I really feel that if we get to a place where we know to explain what the models predicted, not just explain in a decision tree, but really explain in a way that people can understand, that we can justify to ourselves why we made the decisions, that people can read and say, hey, you know what, it makes sense. Then I think it will open up a really brand new window of opportunity for using data science and AI everywhere. That will clear off some of the suspicion, because I think a lot of the regulation and also people that are kind of saying, hey, I'm not sure that I want a machine to make these decisions, are really driven by a lack of understanding of why did the machine say what it says. So I really believe that if we get through that barrier, that's going to be the next really big thing.
Thanks, Avi. Marcus is stretching, so you're next.
I would follow on. I follow on with probably with what Avi said. I think to me, it's being able to see the technology help reduce discriminatory practices and other aspects of the financial services world. So when we say fintech, I'm thinking the application of those tools into financial products. And there's always an intermediary, or there has been heretofore, but with technology, frankly, I would prefer for an AI credit agency to determine my fate rather than a human at a teller, because it's not always balanced. So I think that as we turn the corner and some of the fear of what this technology provides, I think being able to lean into obviously the benefits, particularly around often discriminatory practices in credit markets and other products, and just access, even just having a bank account and the ability to spend digitally, I think is a huge leap forward. So I would say that that's what to me seems like is hopefully next on the horizon when we start looking at using the technology to its best benefits immediately in fintech.
Thanks, Marcus. Abhishek, you want to go next?
So I don't know the answer because it would happen everywhere, and I don't know which will be the most impactful. Broadly, I would say what Raj was talking before, the unbankable, getting them into the banking, loop is going to be one area. But from a more of a tactical, in the context of COVID, I think the biggest impact that I have seen is for digital immigrants. There are companies that are digital native, and their leadership, the C-level, C-suite, always had an appreciation and admiration for AI, machine learning, data, and all of that. But the vast majority of companies were digital immigrants. What COVID has done is it has explained to them the importance of data and AI, because they are put in a situation where the traditional models are not working. So that the fact that AI is an existential threat for any company that is in financial services was not loud and clear before COVID. COVID had made it loud and clear. And to me, as a professional in this industry, that realization by the C-suite, I think, is the biggest impact at a tactical level.
Check. Dr. Raj, you want to wrap us up?
Yep. So since everybody is gone slightly short term, I think in slightly longer term. So I have a 6-year-old son. So I often think about what kind of world is he going to live. So everything that each of us do in this area is going to make his life much better. And actually, I like to quantify. So today, for example, take a person who is making $100,000 a year. They can lead a certain kind of life. And I think when my son grows up, you can buy the same quality of life for $40,000 or $50,000. I think, and the reason I think that's going to happen is because of all the work that we are doing today. Like once self-driving cars come in, nobody has to own a car, and nobody has to even worry. Like the cost of insurance is going to come down, the cost of shipping is going to come down. So a lot of advances are going to happen like this. And I think everything that we do today is a foundation for a future for a much higher quality for our children. So I'm very, very optimistic being in this field. I'm very, very fortunate to contribute to this field.
Thanks, Raj. I know Akshata and Srishti would be happy for their children to have a happy $40,000 a year life in New York. So fingers crossed. Thank you to everyone who joined us today. Thank you to our presenting sponsor, AWS, our signature sponsor, Quant Hub, and one of our exhibiting sponsors, TIBCO, and as well as our supporting university partner, the University of Virginia School of Data Science. Our next event is 2 weeks from today. It will focus on automotive analytics, think self-driving cars. So you'll want to stay tuned for that too. Speaking of the future of that our children will grow up in. Thank you to our esteemed lineup of panelists, and we'll send out a warm good morning to Carolina and a good night to Abhishek, and we'll see you 2 weeks from today. Thank you.
Thank you, Amelia.
Thank you.
Thank you.
Thanks, Amelia.